Dale's question is something that's been brought up before here. Not something I don't want to phrase this, something I'm familiar with because I've had to have these discussions, but not something I'm well versed in because I don't trade these in my personal accounts. We will review what we know and review what we see. Dale's specific question. Can you discuss using ratio back spreads when earnings or other events are expected to cause sharp price moves? I'm sorry, do you also feel there are other strategies which are superior to this in these types of situations? I feel there are ones that work and that I know that work relatively well. I cannot say if they're better than the back spreads because I haven't done that consistently. I only look at snapshots of the ratio back spreads when we have the discussion in these webinars. Okay, so the ratio back spread. Let's just take Dell. We were just looking at it, and I might do CGC. We're going to look at an example of CGC as well. Okay. So we're going to look at Dell again. No events coming up, but let's just take the structure. Let's say we did have an event coming up soon. I might use a call spread. I might use a put spread. You could do it either way. So the standard ratio spread, which I might use in a stock repair, is I might buy an in the money or buy a lower strike call and sell two higher strike calls to create a ratio spread. So buy one, sell two. Okay. In this case, hopefully getting a credit, but it does have a problem of risk to one side because one option is naked. To avoid that, we might reverse it. I might buy two and sell one. Okay, so in this case, we would go ahead and look at, oh, I guess I have to add them in, don't I? We're at 53.61 here, so I'm going to do a 52.5 and a 55. And there's ways to construct this. There's different ways to construct these back spreads, but I'm going to sell actually the 52.5 and buy two of the higher 55s. There we go. So this isn't what I want. Why is this not what I want? What Dale wants, and what any investor who does this around earnings wants a better position, meaning that this is above the break-even and this goes like this. So on the times the stock falls, 8%, 10%, 20% from bad earnings, you still make a profit. Using puts, you'd reverse it, right? Using puts at a ratio back spread, we'd have something like this that profits infinitely to the downside. You get that large 20% gap up, you're feeling great. All right, you're looking good. You got to close this for a loss, but these two up here at the higher strike countered that. You're looking real good. Okay, so that's what we want to see with the ratio back spreads. Yeah, let's go ahead and just, not realistic, but let's fake some prices, all right? So what do I need? I need 410. So let's say I could sell the December 52.5 call for 410 and buy the 255s for 203. Not always going to get these. It's something, I'm sorry, I think I have to update my browser. It's something very temperamental that if I move, it does that. So the idea that you're looking at here is, of course, if the stock collapses, so we're at 53.61 right here, right? There's our visual for the current stock price. We have earnings coming up in 10 days. The stock collapses, goes down here. We win $4. Okay, 4 cent net credit. We make $4 on this structure, 2-to-1 structure. And it gaps up. We have a big move. It stays in the middle. Kind of okay. It moves up 2 to 3%. We're not looking good. We're at the maximum loss. Why is that bad? It doesn't look too bad of a loss. Think about the structure on one way or the other, Dale. If I just used this ratio back spread with calls on stocks that had earnings, every 5 stocks that had earnings every week, for example, what is the likely outcome? And this is based on my experience. You can say that your experience is different and that might work better for you. My experience is that if I opened in 1 month, let's say 5 trades, I opened 20 positions a month to make an earnings play. What I'm expecting to see, so we got 20 total positions, 4 to 5 each week. Let's call it 5 each week, 20 total positions in 1 month. I'd expect that 10%, two of the trades, would drop down here. And I'd expect 10%, two of the trades would move up here. Okay, so we're talking, I'm sorry, here, down here, big loss. 45 here, it's almost 12 points, wow, 8 points. So we're looking at close to that 17, 15% decline. So this is our 15% decline, and this would be our 15 to 20% increase. Sometimes you might see a 20 or 30% decrease too on good stocks. I think Lowe's was huge, wasn't it? Or was it relative? In any case. So 10%, we might see that 12 to 15% move up. 10%, we might see that 15 to 20% move down. I think on average, and then we'd probably increase it. So we might go up to 3 positions, might now be in this 10 to 5% loss range. And then we might have 3 positions here in the 10 to 5% loss range. So where are we at? Well, that's 5 and 5. We're at 10, half the positions. The other 10, I think, are going to fall in this range that only move up a small percent, 3, 4, or 5%. We're still sort of in Death Valley. This might be a bad example because it's at 53, so if it moves up 5%, we're talking $2, we'd be right at 55, 56 in the worst case scenario. But I think the other 10 positions are going to be +5 to -5. You might be picking more aggressive earning stocks, Dale, that swing more widely. I'm talking across the broad-based market. Most of the time I see stocks that may have good earnings, they're high-quality stocks, high volume, 5, 6% movement. You're in Death Valley still. You're coming out of it a little bit, but you're still in Death Valley. 10% of them might see a 15% drop or a 15% gain. I just don't think the way the numbers look, that with the losses you take on this, and you're having a gain here, right? You're having a small gain here. You're having good gains here on 4 or 5 positions, but really only 2. Is that going to counter probably the 5 or 6 positions, maybe 7, where you're going to be taking this loss of 240 and 250 and 260, and on these ones, these 5 you won, you only made another $4, $5, or $6. It's tough to say. What Ernie's been testing and Ernie's been working with, and Ernie's doing his project on, my project is on the bull puts, which is rounding out and going to be finished real soon. 7 modules of 6 or 7 modules of bull put education. He's doing his on long straddles for earnings. It looks like it risks more, but what we've seen and what Ernie's done in his testing, the other reason why I have this numbers is because he profits on his positions just the long straddle. Looking at maybe, let's say, the 55 or the 52.5, where the risk, I'm sorry, that's not a fair representation. The risk is going to be here, but when you have a 5 or 6% movement, you have a profit here. Again, that might happen 4 out of 20. And this might be 4 out of 20. And this might be 4 out of 20. But then the other 3 or 4 positions, you're in this wild swing 10, 15% down for 100, 200% profit to the downside, not $4, or 100, 150% profit on your cost to the upside. His win ratio has been coming out to about 50%, but when he loses, he's losing 60, 70% of what he put in. When he's winning 100, 150, or sometimes even more. So I can't answer your question directly. When I'm doing a play on earnings, it is that long straddle that's short term, accepting I'm going to take the volatility crush because 50% of the time I'm going to have gains from maybe here to here, but then 10, 12% of the time they're going to be huge. They're going to be here and here. And yes, we're going to have some losses in here in the middle. Very rarely are we going to take a 90 to 100% loss. Okay, I'm not sure. I just made an ice cream cone for everyone, so have an ice cream this weekend and thinking of me. So that's why I'm just not sure if this will work long term, because here you're not making much. Whereas those ones you had a 10 or 20% drop with a straddle, you'd be making more and still making the same profit that you were up here on the ones that profited with the ratio backspread. And yes, you can reverse it. And no, you don't, in my opinion, want to do a double ratio. Okay, what do I mean by reverse it? Well, I already talked about how you could set it up so that the put would be like this, All right, so you use the ratio back spread on puts, so naturally you profit on the downside if the stock collapses. What I don't want to do is combine these two together, because then that mutes both sides and drastically lowers the lower break-even and increases the upper break-even. I don't think that's a good idea. I'll say, okay, so on that, let's just look at it. You know, it's a strange structure. I've seen it before. It puts everything too wide and increases this Death Valley range. So in this situation, remember, I bought two higher strike ratio calls and sold the lower and got a credit. So I'd have to do the reverse on the other side, right? We still want to be around the same price, but I'm going to buy, in this case, we're going to buy the 52.5 puts at 2 and sell a slightly in the money 55. And to be fair, wait. Yeah, no, that's right. But I got to put this back up at $4.20, right? Yeah, $4.10 as well. I'll put it at $4.15. Oh, wait. Sell one. I'm sorry. So that would be my ratio put spread, selling 155, buying two 52.5s. So now we're combining the four legs of the trade, and it's just too wide. You know, it's a lower break even of 50, an upper break even of 57.5. It's a strangle. Why not just do the out of the money strangle for lower cost and no monetary requirement on the spread? I wouldn't do this in this situation. I just buy the 52.5 call and the 55. I'm sorry, the 55 call and the 52.5 put for an out-of-the-money long strangle, which have a similar risk of 246, but I wouldn't need the extra monetary requirements in this case from the obligations of the calls and the puts. Okay, so that's just one example. That's why I wouldn't combine them in this case. But I'll admit the out-of-the-money long strangle would have a wider, it'd have a very similar lower break-even and upper break-even. You just avoid the margin requirement, so the risk would be the same at 246. But again, you're just paying into two options instead of, in this case, 6 technically. Same structure. And you don't have the margin requirement to put up. Fernando asks, is the long straddle better to mount ATM or ITM? Ernie's experience in his vast testing has been at the money. There's no reason to try to skew it one direction or the other. Yes, if you guess right, then that would be okay. But if you guess wrong, you're not going to have as much profit if you did at the money. Okay, what do I mean by that? So standard Dell, again, we're going to stay with this. I know earnings are not coming up in December. Again, let's say they were. I'd likely take the 52.5 call and put. It is slightly in the money in this case. I don't have a 54 strike, Fernando. So I've got I'm almost right dead in the half of the two. So I'd probably go with the 52.5. I'd compare both. I'd look at the cost of the 52.5 straddle and the 55 straddle as well. But I'm buying a call. I'm buying a put. Cost might be pretty expensive, $538. Yes, I'm risking 100% of that, but I'm expecting a move. Now, going to the 55, or the 57.5 even, might be a higher cost. Let's use the 57.5. The 55 would be right about here. So the cost might be slightly different to the risk. It's going to come out very similar. But again, what's going to happen is you're going to increase this upper break-even. That's poor drawing, but you see what I mean. You're going to increase this upper break-even. The stock has to move that cost, but from 55 now. So if you're right and it goes up, you'd have been better in the 52.5. But why guess? You don't know what's going to happen. The earnings could be positive. They could beat revenue. They could beat growth. And they could look forward and say, but our next quarter isn't going to be so good, and it drops down. Everything was rosy. So just start at the point. Start at where you want it to be, because you don't know where it's going to go. You can have great earnings and the stock can fall based on projections. You can have poor earnings, but they were less poor than expected, so the stock shoots up. Why try to skew it one direction or the other? You don't get much more better protection. The other thing I mean by that is that when you look at the costs, in this case, and it might even show in this case, Dell again does not have earnings, but look, stock's at 53.61. I skew a little bit to the in-the-money call, out-of-the-money put, right? One side has to be in the money or not. I have a cost of $538. Now, Fernando, if I keep the same, if I change it to the 57.5s, I'm sorry, the 55s is what I meant to say, just so the other direction out of the money, cost is going to be less. But guess what? Not by much. Okay? It's about 20 cents less. I'm sorry, no, it's 538. It's only 6 cents less to go a little bit higher in the money. All I did was skew the upper and lower break-even one direction or the other. Now, maybe, yes, if I have a bearish sentiment and the lower break-even on the 55 is closer than the 52 and a halves, maybe I go with the 55 if I do think that's my skew. But you see where the problem is, Fernando. You're trying to outguess and skew something that you're setting up to profit in either direction because you don't know what's going to happen. Right? Trying to focus right at the money there instead of trying to set a skew where you could actually see the drop you want and not make a profit. Or see an unexpected gain in 10% and not get the 10% from where the stock is and not have any profit. Where here you probably would have been in a 90, 100, 110, 120% profit on the straddle itself. That's a potential. Okay, so I don't want to skew it. All right. Okay, so Dale, here's my final thoughts on that. I can't give you a great comparison, but just based on the track record that Ernie has showed about the number of straddles that he has seen successful, the number of times it drops the lower range, that breakdown I kind of gave you, that maybe 10% fall this range, so you're making a profit, but on the straddle it would have been much higher. We're both going to be in the same dead zone here, Death Valley, is what one of our regular attendees calls it in that case. And, maybe 50% of them are going to fall into Death Valley. And 10 of the positions are, 2 of the positions are going to be here, 2 of the positions are going to be here with this max gain, where you're looking really good on the ratio without risking too much if it went against you. But I'm profiting if it goes against me because I'm not going one direction or the other, Dale. And then you might have another 3% of the time you're in this profit range, and 3 out of the 20 times I'm in this profit range. So there's our 10, and then the other 10 we're in this land where we might have a small loss, small profit, or 4 or 5 times max loss, or near max loss, 60, 70% losses for both of us. I just don't know from the years of trading that Ernie's done this in testing, and again, we are probably talking about different type stocks, but we're all looking at stocks that have earnings coming up in the next 7 to 15 days. And so I can't imagine that this structure, the ratio back spread one direction or the other, would outperform what Ernie's seeing with the long straddle, even accepting the volatility crush for buying into 2, because of those 4 or 5 times, 3 times he's getting profits here instead of here, maybe doubling or tripling the profit, and 10% of the time he's getting these, where we'd just still be getting this on the ratio back spread. Mathematically, I just can't see it outperforming it. But again, that depends on the stocks that Ernie's looking at versus the types of stocks that you'd look at for this, and I can't give that answer straightforward, but just knowing what his testing has shown for the past 3 or 4 years and what he's been doing, I can't imagine it as well. No. Okay, one thing I was going to say here, and I was just getting to this, and Fernando just mentioned something that I completely disagree with. Again, let's think about the numbers I just showed, right? 2 out of 20 times, we're down here at a minus 15% or more loss. 3%, we're between 15 and 7. And 3% here, we're at a 7 to 15% gain, and 2 times out of 20, 10% of the time, we're at a 15% gain or more. And all of the other times, 10% of the time, 10%, half of the time, we're in small gain or small loss, but maybe 5 out of the 20, we're near that 70 to 80% loss. So Fernando says, using 1 ITM short call plus 2 ATM long calls and 1 OTM short call, create a short butterfly spread could be a good idea. Never have I seen it be successful long term. Never. And what I mean by that is no customer I've had since 2001, roughly when I started working with power options, and when I really started to understand it, I have never had a customer long term do butterfly, iron condor, short straddle, or short strangle around earnings be profitable long term. Of these 4, Fernando, I'd say that the structure of the butterfly might be the best as long as this risk is not too high. Because again, 5 times out of 10, you're going to take the maximum loss to the downside. 5 times out of 20, you're taking the max loss. 5 times out of 20 here. Probably another 5% of the time, you're taking small gain or small loss in these zones. And another 5 out of 20, you're taking somewhere of a profit in here. Probably rarely ever getting the maximum profit. I just don't know if the math works out well. But this would be a better structure than the condor, which has a higher risk and lower potential return. And these, I just feel, are disastrous. The short strangle, a naked call and a naked put, when you know the stock could swing potentially 10, 15, or 20% in either direction, you're talking about a 40, 50% loss, on 80% loss, 70% loss on your call premium you received if there's a 10 or 15 or 20% gap. Same thing with the short straddle. I've had customers try this. I've helped customers over the years set up searches for deep out of the money, high probability, 85% probability or higher going into earnings. Throw the probability out the window when you come into earnings. Looking at short strangles with high probability far out of the money for reasonable return. Iron condor positions that at least are slightly protected as a bull put or a bear call. And in this situation as well, I think one gentleman I helped with a short straddle at earnings against my wishes. I told him I'd show him how to do it, but I would never trade it. But I'm going to show him how to use the tools to see what he wants to do. Of the 7 or 8 people I've talked to over the last 5 years that have tried this, I now know 4 of them are doing different strategies. They're not doing this approach anymore. I don't know how long they tried it. I don't know how long they kept it, but I know it didn't work for them. I'd never do anything with a capped gain heading into earnings. Butterfly, potentially, because it has the lowest risk. But I don't want to skew it one direction or the other, and I don't want to have a capped gain. I want to go the other way. I want to have something, I see this, and I see people say, oh, well, what about a lower risk by selling the outside wing? So now you've got sort of a debit spread here or butterfly that's reversed. So I'm doing this around earnings where this risk is maybe around the same, a little bit lower than the straddle, but then here. Well, again, mathematically, is that going to pan out over time? Are the 2 or 3 times we go here, I'm sorry, the 5 times out of 20 that we go there and 5 times out of 20 we go here, we take out the 2 where we would have had maybe double the return, maybe triple. Take out the 2 on this side that have double. Is that going to be enough to be profitable long term? Even with that setup, I don't know. Okay, based on just what I've seen from Ernie's trading. It's so hard to gauge because I'd want to say the iron condor is better. You know, the iron condor with a wider gauge, much better than a short strangle because you don't risk the naked call and the naked put if there is a 15, 20, or even 30% decline. I saw a stock I tracked a few years ago have a 30% loss last month due to earnings. But this idea you're talking about using an in-the-money short, so selling a 50 plus 2 ATM longs, I'm going to have to use the 52.5 and 1 OTM short. So I'm selling, buying, selling the outside wings, buying the middle. So that's the inverse butterfly you were talking about. Did I scroll too much? Oh, yeah. See, this one I don't think I did right. Did I do 2 and 2? My apologies, Fernando. I did 2 and 2. So this is the reverse one you're talking about. That doesn't have a capped gain. I understand that. But it does have a capped gain. Okay? And think about what I was talking about there. So your structure here on Dell compared to the other 2 structures we looked at with the straddle, the upper and lower break even look pretty nice. But then beyond that, we're capped out. And this is only at $38. Okay? We don't have the infinite structure. And you might say, oh, well, I would have used the 55 and the 52.5 and then the 57.5 or maybe skewed it to the 60 for sort of a broken wing reverse butterfly. But think about it again. Those 5 times you see the move you want, you're capping the upside. 5 times out of 20 you see the move down, you're capping the downside. 4 or 5 times you're in this mid-zone range, and another 4 or 5 times you're in this loss range. I don't know. I don't see it working out long term, just based on the track record I've seen Ernie's had with these around earnings. I think it's better to just be the V and not try to skew it one direction or the other with the ratio back spread. Dale, I have to agree with you that I would, looking at it going forward, the ratio back spread is much better than a straight ratio spread around earnings. Don't get me wrong. The fact of not still having some profit here, but mitigating a death valley just by what I've seen with Ernie's trading and the project he's working on for this. I just can't see that it would outperform just buying the long straddle around earnings, taking the profits, accepting that half the time you might be taking a 40, 50, 60% loss, maybe not even half the time. I think half the time you might, let's say we average around a 50% loss, and 30% of the time you're only making 40 or 50%, and then other remaining 10% of the time you're hitting 150, 120, 130, maybe even a 200% gain with that unexpected wild move on the straddle position. Just by the math and the structure, Fernando, as we were talking about, I can't say that this would outperform what Ernie's doing right now, because I don't think the benefit here of the slightly lowered risk from selling the premium pans out, because you're still taking losses a fair amount of time. Okay, it's not $500 that we saw with the strangle. It's not $400 that we saw with the straddle. But still, you know, how many times, just in this structure we're looking at here, if I took one loss at 212, how many wins do I need at max on either side to make up for that? 7. That's still 7-to-1 risk-reward ratio around earnings, which are extraordinarily explosive. We don't know what's going to happen. I'd rather leave the upside and the downside open. I'd rather leave that wild direction open to profit long term. And if Ernie's testing proves me wrong, Ernie's testing will prove me wrong. And I will let you know that as soon as I know that. But he's still doing his project because it's still working out for him to be profitable long term, doing this approach with the straddles at the money, straightforward straddles around earnings, accepting a volatility crush, not complicating it by trying to lower the cost by selling premium, which caps the profit one direction or the other when it does swing. So far, from what I've seen from his notes and from some of his examples, those numbers I used are based on that. And 10% of the time you see that great swing you want, 15, 20%, you know, and then you start to see a little bit more where there's a 5 or 6% or 7% move, and you might not get as much profit as you want, but you still profit on the straddle in the other directions. And then you have some positions that have a small loss that didn't move as much as you wanted, you know, the 4%, 5% up, so you might not have profited on the straddle. And there's a couple I had one. I'll admit it. It was when I was in a married put, and I added a long straddle on the thing to try to boost extra profit to me as we came into earnings. Earnings hit. The thing moved 1.8%. It was a dud. I lost $200 on the straddle, almost 80% of what I put into it, but I gained 2% and 1.8% on the stock in the married put position. It was essentially a loss or an addition of an extra $120, I think it came out to be. Those are the ones that hurt. You know, you see things and it looked good. I'm not going to say, well, obviously it wasn't gangbusters, but the earnings looked good. They were close to in line, a little bit off on the revenue, but still reasonable. And just 1.8%. Straddle's gone. It's essentially worthless. I held it for an extra 3 days as the stock moved to try to get more money on the call side, so I didn't take the full 100% loss or 95% loss right away. But Ernie's going to include that too in his project. He's going to include the management techniques he may or may not consider if it doesn't do what you want after the first instance as well. All right. Well, ladies and gentlemen, I don't see any more questions that came in. So I'm going to navigate back over here, but if you do have a last-minute question, I highly encourage you to send that in. It's only 5:35 p.m., 5:37 p.m. Eastern Time. I do want to remind you all that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge based on discussions I've had with other investors, what I've done in my personal account, and what I've seen others do that have worked as well. But any direct stocks or options discussed today should not be taken as direct trading suggestions. I will say that following Ernie's full project that I know hasn't been released yet, if you asked me what strategy I would trade around earnings, I'm going to say the long straddles based on Ernie's discussion because he's been testing it thoroughly and trading it thoroughly, and I've been trading it somewhat following his notes and what I've tried to also trade on my own over the past few years with these at-the-money long straddles. And I just don't know if those other ones work well. I will say that ratio back spread that Dale gave to us does have an interesting risk-reward profile because set up right, you take little risk or would have no loss if it moves in that one direction. And that's great. You just got to worry about the death valley in the middle. And of course, talking to the protection, I prefer the married put way that I use for radioactive trading. You heard Sam mention that he thinks the risk Terry and Cliff might have entered with that 20% protecting 80% of the stock price once they get it put to him, using that deeper out of the money put for lower cost. He feels that's too high for himself personally. These are personal thoughts. I think that risk is too high for me personally. I stay at 5 to 8%. Sam says he stays around 7 to 8% if he's using the puts for protection as well. Those are just thoughts. And what's worked for me in the past and what's worked for Sam in the past as well. So I'm not saying I'm going to go out and buy a Mary put on CRE today that we discussed in the first section. I'm not going to go out and do a straddle on Dell or a ratio back spread on Dell. These are not direct recommendations or suggestions. We just wanted to talk structure, what we've seen, and how that can help you going forward. Options do involve risk, may not be suitable for all investors. You like some of the tools that you saw today, the portfolio tools with those rollout opportunities programmed in for you for most strategies, as well as taking a look at some of the other tools we saw today, a little bit on the search and a little bit on the custom spread tool. Remember, you can test out the tools for free at any time, no credit card required. Just go to powerup.com, put in your name and email address. You have full use of the site for 14 days. Subscriptions, monthly subscriptions to Power Options start at $45 per month after that, but we do offer other services for historical data in real time. Naturally, the price moves up from the lower end. Well, this weekend, you'll see some other information. I'll probably get the first section of our discussion out to you hopefully by Saturday or Sunday. Also more, but you can also get more free information at blog.powerup.com. You can check out our free webinars page at any time, powerup.com/webinars.asp. A lot of our webinars, as you know, are posted for public on YouTube. You can check it out at youtube.com/poweroptions. David's video regarding the historical tools and what's the benefit of the historical searching capabilities and how to use some of the historical tools had a hard time rendering after I made a couple adjustments to it, and wasn't able to get it finished, believe it or not. It crashed on me 5 or 6 times. So I'm hoping to have David's video from last week on the historical tools, the first part of this week, to be posted sometime Sunday before dinner time is my goal. So look forward for that. I'll send you an email as always letting you know when the new archives are posted. If you haven't seen some of my emails, of course, recently within the past 3 days, going right to YouTube, of course, itself. There, some of the recent ones, can stock volatility rise as implied volatility falls? That was our discussion we had with Fernando last week. We talked about the percent IV range, how to use it on power options, the filter on power options, what to look out for. And we had the diagonal call spreads with a protective put from a few days ago. That discussion as well, similar to protecting the stock with a put, but looking at it in a diagonal call spread as well. And we've got some other ideas. A good idea to roll down a naked put in the last week, 4 questions on iron condors, and a lot more. So you can go through all of those if you missed any of the emails with the recent 12 or 15 videos we posted within the last month or so as well. Okay, so that's just more education that you can take a look at anytime the weekend if you want to get more going there as well. But if you think of any other questions, Sam just commented and he says, yeah, I traded SSI, stock bought at 310 and is still at 430. I think you bought 300 shares. Excellent. Excellent move on that stock. It's a 34% gain. It's a good one. SSI. I haven't checked that one out. But if you think of any other questions this weekend, remember, send me an email at any time to support@powerup.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And, of course, trial members and subscribers, you can schedule a coaching session at any time, essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. Ladies and gentlemen, thank you again. Have a fantastic weekend. We have short week next week, remember. Full day Wednesday, market close Thursday, half day on Friday. I do not think there will be a Friday session next week, next Friday afternoon, because most of us will be traveling or doing things with our family. So if the market closes at 12, 12:30, 1 o'clock, there's no point in having a webinar at 4:30. So no webinar next week, but I'll let you know if we're doing something earlier in the week. Take care, everyone. We'll see you soon. Good night.